Okay, good evening once again, everyone. So we are continuing from where we stopped last class. We are in chapter 5, taxation and inflation. Chapter 5 from our pack, page 135, taxation and inflation. So last class, we were able to discuss the effect of taxation on the capital budgeting. And we look at how to compute that a little bit. Then we also look at how to use capital allowance when we are computing our tax. And we conclude at the last slide that what we actually need for the purpose of MPV is the tax savings on capital allowance. That the capital allowance itself is not a relevant cost, but what is relevant cost is the tax savings on that capital allowance. And we try to look at the method of computing capital allowance. Basically, we discuss two methods. That we have straight line method and reduce balance based method. And we use example, and also we talk about the time you cash flow. I said that when you acquire an asset will be acquired at the beginning of the year or at the end of the year. And I said if assets acquired at the beginning of the year, automatically when you are computing your capital allowance, you have to start capital allowance in 1 year's time. That is, if you acquire an asset by 1/1/2019, automatically your capital allowance will start when? 31st December 2019. This is year zero. I told you last time that I don't like year zero, you just try to refer to the point in time. That is, year zero means now. So in that case, your first allowance will not be what? Year 1. I mean, but on the other way around, if you acquire an asset on 31st December 2019, then automatically you have to claim capital allowance that year end that you are putting here. That means you have to claim capital allowance claim 31st December 2019. That means this is your year zero and this is your what? Year zero. So that's how you started claiming your capital allowance based on a point in time. So away from that, I think where we stopped last week is that we actually learn how to compute capital allowance, as I've said earlier on, that we use straight line or reduce balance method. But we have not considered the effect of balance charge, or let me say balancing adjustment. That is the balance of balancing charge or balancing allowance. So let's quickly look at it now. Capital allowance and balancing charge and balancing adjustment. So in this aspect of capital budgeting, when you acquire an asset, and you are claiming capital allowance on it, it is possible before the useful life of the asset. You remember that at the end of the life of the asset will have a disposal value, or we can dispose the asset off at any point in time along the life of the asset. So in view of that, the assets can result to either disposal can result to either balancing charge or balance allowance. And from our tax knowledge, we agree that our balance adjustment is equal to the sales proceeds less tax written down value, right? Then you have your balance adjustment. And from our tax knowledge, we assume that this balance adjustment will be what? Balance charge or balance allowance. Normally, from our knowledge of tax, this balance allowance is an income that you have to pay tax on, right? While balance allowance is an additional capital allowance that you have to claim. But don't forget, we are not dealing with taxation here. What are we dealing with? We are dealing with SFN. What we are saying is this: when you acquire an asset and peradventure you are going to claim capital balancing charge on it or balance allowance, let's quickly run through the manual before we practicalize it in a real question. When an asset reaches the end of its useful life, it will be scrapped or disposed of. An asset might also be disposed of before the end of its useful life. On disposal, there might be a balancing charge or balancing allowance. This is different between, right now, you could have what? Balancing charge or balancing allowance. It is different between the tax level of the asset award and the disposal value, the sales proceed. That difference could result in what? Balancing charge and balancing. Now, at what point do do you have balancing charge? Or at what point do you have balance allowance? Look at it now. Balance allowance. This occur when the written down value of an asset for the tax purpose is higher than disposal value. When this written down value, when it's higher than sales proceed, what do you have? You have what? Balancing allowance. For example now, if your sales proceed is 500 naira and your tax written down value is 600 naira, what do you have? 100 naira. That's what we want. Balance allowance, because your tax written down value is higher than your sales proceed. But the other way around, when your sales proceed is 400 naira and your tax value is 200 naira, what do you have? You have to. That's our what? Balance charge. So balance charge is when your sales proceed is higher than your tax written down value. So the balance allowance is an additional claim against taxable profit. I say here that from our knowledge of tax, when you have balance allowance, is part of the capital amount that you have to claim for that year. I want to hear now. Or the other way around, balancing charge, this occur when the written down value of an asset for tax purpose is lower than disposal value. That I give example on the board. When you have sales produce of 400 naira and your tax value is 200 naira, the difference of what is your balancing charge. In that case, the balancing charge is taxable amount and will result to an increase in tax payment. We are told to from tax knowledge, what do we do? We add it to our accessible profit so that we will pay tax on them. So impact, now don't forget, our target here is computing capital expenditure, that's NPV. So how does it affect our capital budgeting decision making? So the impact on this analysis now, the cash flow or cash payments is included in cash flow for this analysis, either in the year of disposal of the asset or in the following year, depending on the assumption used about the timing of time payment. That is the impact of this one now. What will be the impact? If you have balancing charge, that you have to pay more tax, so tax on it, you have to pay. That's a outflow. But if the balancing charge, what are you doing? You are selling tax on it, that's what tax saving. So that's how we want to look at now. So note, an annual capital allowance is not claimed in the year of disposal. That's one of the things that you have to be very careful. Any year of disposal, you are not expected to claim capital allowance. Hello? So anytime we are reading the question where the asset is disposed of, you must not claim capital allowance in the year of disposal. Let me read again. Note, annual allowance is not claimed in the year of disposal of the asset. Instead, there is a simple balancing allowance, that is, or balancing charge. So in view of that, let's try to practicalize a real question on how to deal with the capital budgeting. An impact of this analysis: a company is considering an investment in non-current asset costing 80,000. The project will generate the following cash flow: year 1, 50,000; year 2, 40,000; year 3, 20,000; year 4, 10,000. The capital allowance are claimed at 25% by reducing balance method, and the first tax benefit will occur 1 year after the date of the acquisition. That is T1. It's expected to have a scrap value of 20,000 naira at the end of the year 4. The post-tax cost capital is 9%. Tax of profit is 30% and paid 1 year in arrears. You are required to calculate the NPV of the project. So to that question now. This question, there is a capital budgeting costing 80,000 naira, and don't forget, this question has a tax. So we want to look at the impact of capital budgeting and taxation now. The first thing you have to transfer to your mind is that you must try to bring out all our relevant costs first. And from this question, what I have read so far, the relevant costs so far are 1. So look at it, our relevant costs. Relevance cost. 1 is what? The cost of the machine, non-current asset. The cost. How much is it? 80,000. We don't forget from our relevant cost perspective, we said that when a company is acquiring an asset for the purpose of the capital project, and the asset is not available, then and you want to acquire that, the future cost of that asset is relevant. Number 2 now, all the cash flows And for this question, they help us to get bring out the cash flow. Year 1, year 2, year 3, and what? Year 4. What do we have? 50,000, I mean, followed by 40,000, followed by 20,000, followed by what? 10,000. That's our cash flow for the project. Now, the next relevant cost that we should be looking for here is what? Taxing is the scrap value. Scrap value is there. The scrap value. How much scrap value? 20,000. Okay. Then the next one to be taken off is what? Is the taxation. Tax. So tax now. Tax. The tax, I mean. Now, and the question, how many percent is it? 30%. 30%. This is just the rate, I mean. You monitor the cash flow that goes to that tax. Now, let me quickly start from the scratch now. There are two ways to address this problem. There are two ways to do what? Now, the first that come to your mind, since this asset that you are going to acquire is allowable for capital allowance, is what? So the first thing we have to do now is that let's put our capital allowance on that asset. Hello? So now, let me go to the computation of a capital allowance. From the question, we were told, how do we do the capital allowance? Capital allowance is claimed on at 25% by what? By reducing balance method. I followed the lead. I'm asking the method that we use to capital allowance here is on what? On reducing balance basis. Okay, in view of that, let's quickly, but don't forget, this asset is disposed of is what? Disposed of. So our capital allowance now, our pattern again, we have years, Abi. Am I talking years? Our tax rating down value, Abi. Then let me say our capital allowance and probably the tax savings on the capital allowance. Now, the assets acquired at year 0 at what cost? 80,000. Now, this question is silent to tell us when is asset acquired. Hello? I say asset will be acquired at the beginning of the year or at the end of the year. This question now, nobody tell us when the asset is acquired. I mean, please, in a real question, watch out for when the asset is acquired. Because that timing, we turn the question upside down. Am I talking now? You must know the timing of the graph flow. Is it at the beginning or at the end? But as they've said it now, this one now, I will assume at the beginning of the year. So that means my capital allowance can be first of what? Year 1 time, Abi. My year 1 after our capital allowance, reduce balance rate 30%, 25%. That was 8,000. 20,000. Let's try to pass a little bit. 20,000. Abi. Then we have 60,000. And our tax rating down value for year 2, capital allowance. How do we have again? 25%. What do we have? 15,000, Abi. Okay. What do we have next? 45,000, right? Our tax rating down value. Then year 3, our capital allowance again, 25%. What do we have? 11,250. Okay, then by year 4 now, this is our tax rating down value. Don't forget, how many of this project has 4 years? And I said something. Once an asset has a scrap value, in that last year, don't bother to compute capital allowance again. Don't do what? Don't do what? Don't compute capital allowance. What you have to do is this. In that year 5, in that year 4, what is the scrap of the asset? The scrap value. Maybe let me. Sorry, give me the reason value first. This value. 33,750. So they have the scrap how much? 20,000. That's the scrap value. So by the time you compare the scrap value to original value, what do we have? 30,750. What the balance of balance allowance? Is it balance charge or balance allowance? Balance what? Balance. Why is balance allowance? Because the tax value is what is higher than the scrap value. So we have what? Balance allowance. We have what? Balance allowance. So balancing allowance. So in view of that, We have computed that. We're going to forget what do we need? We need account allowance out through. We have first one is what? Year 1, 20,000. Year 2, 15,000. Year 3, 11,250. Yeah, this one now. Go with this one again. This one also be 30,750. Please don't forget. I said anytime you have balance allowance, it's what is an additional capital allowance that you have to enjoy. Abi? So in that case, how much do we save now? I mean, what are tax rates? 30%. Abi? How do we have here? 6,000. 4,500. 3,375. Yeah, 3,375. Followed by 4,125. For the purpose of our NPV now, for the purpose of our NPV, if I need to for the purpose of our NPV now, what I need, what we need is what? Is a tax savings. Is what? We don't need the capital allowance. But I will explain something later. So how we done this now? We have got our tax savings capital allowance now. But we have to put our tax go over there. So our next cash flow, let me try to bring my relevant cost now. This is 1, let me label it. 2, 3, then 4 now. Let me now put tax, which is 5. So our tax cash flow now. Our net cash flow normally year 1, year 2, year 3, year 4. What are the cash flows? 50,000, 40,000, 20,000, and what? 10,000. And 10,000. Then this is our net cash flows. Our tax rate. We are using tax rate, we are tax rate of all this one now. 15,000. So 15,000, 12,000, 6,000, and what? 3,000. So having done this now, the next thing is we have put our NPV. We have put all our, we have got all our relevant costs now. We have the cost of the assets, we have the cash flows that we are going to pay 1 year, we have our tax capital allowance, we have our taxation now. Let's put our cash flow schedule now. Our NPV schedule, that's our solution now. Our solution, we have NPV schedule now. So we have years, year 0, year 1, year 2, year 3, year 4, probably year 5. Because according to the question, we're told that the tax is payable what? In arrears. Tax is payable in arrears, so we have to extend to year 5. So if you have that, let's try to get out our number 1 is what? The common the non-current asset. The cost price, how much cost price? 80,000 comes in year 0, Then our cash flows for the project. 50,000. Year 1 is 50,000. Year 2 is what? 40,000. Year 3 is what? 20,000. Year 4 is what? 10,000. Am I communicating, please? Yes. Now, the project has a scrap value, right, Abby? Yes. Let's bring it in. The scrap value. The scrap value. Yeah, that would be dash. When is it coming? Yeah. It's coming in year 4. Because the scrap value, it comes in as inflow at the end of the project life. I will do that now. Yeah. So the next thing is that how much are we going to pay as our tax? This is Abi. Please don't forget this is our cash tax outflow. Abi. We are paying. It's an outflow. But we have tax now. We have when are we going to pay it? 1 year delay. So year 1 go to where? Year 2. That will be how much? 15,000. Year 3, 12,000. Year 4, 6,000. Year 5, 3,000. So if you have that, what do we do now? We now bring our taxes from capital allowance. We have a tax savings on capital allowance. Yeah, don't forget how to pay our tax also 1 year delay. Yeah, how go to where? Year 2. We have how much? We are saving 6,000 savings, 4,500 savings, then 3,375 savings, and the 4,125 savings. So we have input all our relevant costs to this schedule now. All we don't do get our net, our net outflow. Okay, this will be what? 80,000. This will be what? 50,000. So called 31,000 addition. What do we have? We have calculator. 12,500 abi followed by 375 1125. No excuse, okay. After all that now, what do we do next? We bring in our this year already, our discounted factor. How many percent? 9% of the question. 9%. 9%. So your one will dash. So the one like yeah, 9% this year factor. 9.74 0.8417 0.7722 7084 0.6499. So let's multiply now to get our present value for each of them. Our PV. Last one. 731.
First one 45.
First one should be 80,000. Year one.
45,870.
870. Second to the last. 19,392.
The next 26.
26,000.
093.
9,000. 653. So therefore, our NPV is how much? Yeah. 21,739. So that's how you address the solution when there's a taxation and there's an available and the asset is alive for capital allowance. That's what we do. But let me now explain something better, a useful thing that we can be very complex a little bit now. If you don't want to address your capital allowance like this, you want to do what? Capital allowance like this. And you want to do with this tax capital allowance. There's a way you can incorporate it in computing your tax. Now look at this question now. I've computed my tax like this, my capital allowance like this, and I've gotten my tax savings. If I want to do it like this, there's another way I can turn it around. Let me pause something. What I'm trying to say is this: if I don't want to pass through that procedure that I did last time, I will just hello together, please. Please listen to YouTube now. I will compute my capital allowance as usual like this. I will now use capital allowance. I will pretend as if I'm doing tax, normal computing of tax. In computing my taxation now, what are my cash flows? My cash flow are 50,000. Am I talking? We have 40,000. We have 20,000, and we have what? 10,000. Am I talking? Then these are my cash flows before tax. Then I will not bring in my capital allowance in straight away. I bring my what? Capital allowance in straight away. In year one, how was my capital allowance? 20,000. I will say 20,000. I will say 15,000. 11,250. And what? 13,750. Am I complicating this? Then I will get my next cash flow after capital allowance. We have the difference. That's 30,000, 25,000, 8,750, 3,750. Negative value. So this is the figure that I will tax. Now let's tax it now. Our taxation now. Tax of this figure. 9,000. 7,500. Any go? 2,000. 625. Any go?
1,001.
1,000.
125.
125. Savings abi. Don't forget all this one are what? Are payments, and what? Savings abi. So in view of that, by the time you now get to your NPV schedule now, you will bring in your capital cost as usual, you will bring in your cash flows as usual, you will bring in your what? Your scar value as usual, but your tax cash flow will be what? Will now be different. Now, year one goes to where? Year one goes to where? Year two. How much? 9,000. Year two go to where? 7,500. You go to where? 2,625. Abi? They go to where? 1,025. By the time you, in this case now, you cannot bring in tax savings or capital allowance again. Am I talking now? But if I now, what are you going to get? You still get the what? The same results. So that there are two ways to address your capital allowance now. You can follow, you can use capital allowance to compute your tax normally like this. And whenever you ask your tax, that is the only thing that you're going to report in your NPV. Am I talking now? Or you compute your capital allowance like this, get the tax savings on it like this. Am I talking now? And compute your tax on the capital alone. That is, in that case, you are bringing in the tax in. You also bring in what? You are bringing the tax and capital allowance in. Either of the way, you are going to have the same net cash flow like this, and your answer will be what? Will be the same. Am I talking now? So depend on the method you want to adopt. Two methods is very, very important. But at the long run, at the long run, I keep no way. One method will supersede another method. This method, the taxation policy will override other method in here. Am I talking now? When we get to that level, I will let you know that. But there are two ways to address this kind of question. You can use your capital allowance like this to compute your tax, or you get your tax and capital allowance, and so that in that case that you are bringing two capital tax and capital allowance and taxation. Or use one leg, get your tax like this. Once you get your tax, just report the tax alone. That's all. You have the same result. Am I communicating now? So away from that, I'm with you. So away from that, let's go to. Okay, I think another example. At least another example. Same question. What should be? Same question. What should be? Okay. Okay, same question. Okay. So let's go to another aspect. DCF and inflation.